For most of us, taxes are just that thing, a bill we have to pay. It's that chunk of money that just disappears from our paycheck before we even see it. But what if we've been looking at it all wrong? What if the tax code isn't just a collection system, but more like a rule book full of incentives, a strategic guide that, if you understand it, can actually be a powerful tool for building wealth? All right, let's dive right in. Okay, check this out. This right here is the fundamental difference in how money flows. If you're an employee, the sequence is set in stone. You earn your salary, the government takes its cut right away, and then you get to spend whatever's left over. But for a business owner, that sequence is completely flipped. They earn money, then they spend it on business expenses, growing the company, and then they pay taxes on what's left over. This one little shift, well, it's the core of everything we're about to talk about. So why on earth does that difference exist? Well, it's not a mistake, that's for sure. The tax code is less of a bill and more of a policy document. The government actually gives out specific tax breaks to encourage people and businesses to do certain things it wants to see happen in the economy. It's really a system of rewards for participating in a very specific way. And what are those activities? Well, the big ones are pretty clear. The government wants to encourage business creation, investment, and even a little bit of economic risk-taking. It also really wants private citizens to provide housing so it doesn't have to. So when you do these things, you're not just some random person. You're basically partnering with the government to help them meet their economic goals. And partners, well, they get benefits. Now let's get into the nitty-gritty. We're going to talk about the single most powerful tool inside this whole incentive system, the engine that really drives tax strategy, especially when it comes to creating wealth, is real estate depreciation. So what in the world is depreciation? Well, the tax code lets you treat a building, a rental property for example, as a business asset that on paper wears out over time. This creates what's called a phantom expense. It's a tax deduction you get for this supposed loss in value, even while in the real world your property's market value is probably going up. Let's make this super concrete with a simple example. Imagine you go out and buy an investment property for a nice round $1 million. This number is going to help us see exactly how these mechanics work. Now, here's a really critical distinction. You don't get to depreciate the whole $1 million. The tax code basically says that land doesn't wear out, so you can only deduct the value of the building itself. So for our example, let's just say that's $900,000 that you can write off over time. And this is where the magic of the paper loss comes in. You're getting a tax deduction every single year based on that $900,000 building value. But here's the kicker. You're not actually spending any cash. It's an expense that only exists on your tax return, pushing down your taxable income, while the property itself is likely putting real cash in your pocket from rent. Okay, that's already pretty powerful, right? But what if you could take this whole depreciation engine and basically put a supercharger on it to slash the taxes you owe on your main salary from your day job? Let's check out how that works. This is where something called accelerated depreciation comes into play. Instead of spreading that $900,000 deduction out nice and evenly over decades, a cost segregation study goes in and identifies all the parts of the property that wear out faster. We're talking carpets, appliances, light fixtures, you name it. This lets you front load your deductions and take a huge chunk of them in just the first 5 to 7 years. But wait, there's a roadblock here for most high-income professionals. The IRS usually says that rental income is passive, and you can't use passive losses to cancel out your active income, like your W-2 salary. So, how do you get across that barrier? Well, it turns out there's a massive exception written right into the tax code for short-term rentals. If you meet 2 key tests, first, the average stay for your guests is 7 days or less, and second, you materially participate in running the property yourself, meaning you're not just a silent partner, the game completely changes. The IRS no longer considers it strictly passive. And that huge paper loss can now be used against your active income. So look at the impact here. Let's say you're a professional making $100,000 a year. You buy that $1 million short-term rental and you do that cost segregation study. This lets you accelerate the depreciation and generate a massive first-year paper loss. Let's call it $120,000. Because you meet those short-term rental rules, that loss can now jump across the barrier and wipe out your entire taxable income from your job. Your tax bill could literally go to zero. Now, these awesome tools don't just exist on their own. They're all part of a much bigger strategic framework that also includes how you structure your business and, just as importantly, how you plan to pass that wealth on. Picking the right business structure is a huge strategic decision. For a lot of people, an LLC is the perfect way to start. But as your business grows and gets more profitable, switching over to an S corporation can be a total game changer. It lets you pay yourself a reasonable salary, which gets hit with self-employment tax, but then you can take the rest of the profits as a distribution, which doesn't. For a business with $100,000 in profit, that simple switch could save you thousands a year. Okay, now this might be the single most powerful wealth preservation tool in the entire tax code. It's called the step-up in basis. When you inherit an asset like real estate that has grown in value, the tax code basically hits a reset button. Its original purchase price gets stepped up to whatever its current market value is. This means all the capital gains that built up over the original owner's entire life, they're just poof, gone. It's how massive amounts of wealth can pass from one generation to the next completely tax-free. So here's the crucial takeaway. There is a world of difference between a tax accountant and a tax strategist. Your accountant is looking backwards. Their job is to make sure you reported what already happened correctly and on time. A strategist, on the other hand, is looking forward. Their entire job is to legally structure your finances to minimize the taxes you'll have to pay in the future. And let's be absolutely crystal clear about this. None of this is about hiding money or doing anything illegal. This is about tax mitigation. It's about understanding the rules of the game exactly as the government has written them, and then legally and ethically aligning your financial moves with the very behaviors the tax code was designed to encourage in the first place. So I'll leave you with one final thought to chew on. When you look at your tax bill at the end of the year, what is it really reflecting? Is it just a simple measure of how much money you made? Or is it actually a report card on how well you've understood and played by the strategic rule book of the entire economy?